Ease of transfer. I kind of touched on that with the point I just made. Again, sole proprietorship, much more difficult to transfer. You're not transferring an entity, you're transferring a compilation or a pile of assets and debts. So really each of these is independent. So there is no unit that's being conveyed. You can certainly transfer businesses that way, and it has been done, but it's much more murky when you're trying to deal with it on the basis of a sole proprietorship. And there's also issues relating to, what about the value of the business above and beyond that of its assets? I mean, goodwill is often more than 50% of the value of a small business that is primarily a service-related business. So what you're selling really is the goodwill, the reputation of your activities. But that's not embodied in anything. It's embodied in your name in the community. But you don't have an entity that can claim ownership of that. You claim it. So under those circumstances, if you were attempting to convey the business, you'd really need to create a corporate form or some other entity and then transfer that entity along with covenants not to compete and other contractual obligations where you assure that this value in your business is getting conveyed. Much more complicated with a sole proprietorship. Relationship to control. I guess you can control the business pretty easily in a sole proprietorship in one sense, but certainly not if you have others involved. So for all these reasons, I think that very little can be said in favor of operating your business in that form. So what else? General partnership. Certainly you're familiar with this. General partnership is where you and your buddy get together essentially formally or informally and conduct a business. The IRS does not recognize a general partnership as being an independent taxable entity. You do file an informational return with the IRS on a regular basis, but the good news is the general partnership itself does not generate a tax. Instead, your portion of the net income each year or the loss will be, you'll get what's called a K-1 that's issued by the partnership, and then you'll include that with your 1040 and claim that income on your 1040. Partnerships don't protect you from liability beyond that of the entity. In other words, it's not like a corporation, which we'll come to in a minute. So a general partnership is an entity that is useful in the sense that it consists of contracts typically in which each of you have an obligation, you have duties. Your responsibility can be limited to some extent in terms of the torts that are committed by your partner, depending on your state. You may not be personally liable for. There's some dispute about that, and it would depend on the nature of the tort. But there are some business obligations in which your liability may have some limitation. But for the most part, a general partnership, as the name implies, means general liability of the parties. You don't form that entity for purposes of limiting your liability. You do it so you can have a synergism with other people in generating profit, but not insulation from liability. Now let's move on with that. So I think I've been pretty dismissive on the issue of a general partnership. It serves its purposes in many ways, but not if you're doing asset protection planning. Corporation. Corporation is the most common option that people have to conduct their business. You probably have some familiarity with that, I'll bet. And again, I'm betting some of you already have corporations forms, but you may not know, what all the implications are of that fact. And you won't unless you've done some independent reading or your lawyer has taken a lot of time to explain it, which usually I don't find that either of those two things are true. Tax effects of a corporation. Well, it does have significant ramifications from a tax standpoint. A C Corp, meaning a standard corporation, is one in which the entity is taxed at a corporate rate, a rate that's fairly high. It's called a compressed rate, meaning you get very rapidly from $0 up to the top rate. The top rate, as I recall now, is around 35%. So it's a high rate that you pay, and you pay it very quickly on the scale of income brackets. So when you're considering that, you have to think, well, gee, am I going to pay taxes twice? And there's a chance you may. Whenever you have earnings, profits in a corporation, those profits are taxed. And then if it's distributed to you as a shareholder in that corporation, even a closely held corporation, then when it's distributed to you, you pay taxes on that. So arguably it's taxed twice. Taxed once is profit to the corporation, second is dividends by you. Now the taxation to you and the dividends now, I think that rate is 15%, so it's very small. So the good news is that dividends are very favorably taxed now, but that may not always be true. And it's still a double tax. Now I should point out that with small, closely held corporations, there are opportunities for you to minimize that, and it's routinely done. And it's perfectly permissible. To the extent that you increase your salary, you've created a deduction on the corporate level, and it's income to you, but it's not profit to the corporation, right? Because you got it out as a salary. So there's no dividend involved. It was an expense to the corporation. The corporation deducts it, you declare it as income. So there's a lot of opportunity to get income out of a corporation that way and avoid double taxation. So I would argue that with a C Corp, particularly closely held or small corporations, they often avoid any dividend taxes. But again, this is not without limits. You have to be reasonable. And the IRS, as you might imagine, scrutinizes these deals. And if your salary gets unreasonably high, then you can believe that on an audit, the IRS is not going to take well to that. In fact, they'll consider it a constructive dividend, and that can have substantially harsh tax consequences to you. So you don't want that to happen. So if you're operating a business and you're paying yourself first, there's $100,000 in what otherwise would have been profit, so you pay yourself a salary of $100. The next year you pay, the year's good, pay yourself $200. Next year the year's good, $300. That can't go on forever. It's not going to be realistic. But I am arguing to you that there's a fairly comfortable range for most people to get out a comfortable salary, which may include all their net income from the corporation to themselves. That's not at all uncommon. But technically, could you be looking at double taxation through a corporate form? Certainly. Now, is there a way around that? And many of you have been wanting me to come to S Corps already, because many of you who have corporations are actually filing as what's called a sub-S corporation. This is an election that can be made for tax purposes, an election in which you can choose to be treated as if it was a sole proprietorship for tax purposes. The advantage of that means that there is no issue of taxation at the corporate level. There's no dividends issue. You just declare that income on your personal return, and it's taxed accordingly. So a sub-S is a great advantage, but it's not something that comes without limitations. There are limitations that exist to using sub-S, but not limitations that are a problem for most people. Now, the primary ones are you have to be a U.S. citizen. The shareholders, I think you probably meet that test. It has to be a domestic corporation. I bet you meet that test. You can't have more than, it was 75, I think it's been raised to 100 shareholders. So there's a limitation on the number of shareholders that can be involved. And finally, there's a limitation on who can own stocks, meaning that some entities can't. And I think trusts and estates are permissible owners, but not corporations. So if you had a shareholder that was a corporation, for example, that's a problem. It could kill your deal on your sub-S categorization. And you don't want to fall out of sub-S, because if you're moving along with the assumption that you have approval from the IRS for your sub-S, and then it turns out that you're disqualified, that can have huge adverse tax consequences to you. So the corporate form is wonderful in many ways, whether it's a C Corp or an S Corp. I guess I've made clear to you that you can even be a C Corp and maybe avoid the double taxation issue, but certainly you can if you qualify as a sub-S. From a protection from liability standpoint, corporations are wonderful. I mean, they're intended to deal with that business litigation that routinely arises. If you make a product and the product is faulty, that's going to be protected by a corporate form. All those standard lawsuits that you associate with doing business, a creditor. If you signed the contract as an officer of the corporation, then that's going to be protected. Now let me emphasize that. You have to sign as an officer of the corporation. So you have to insist that once you have a corporation, that all those people with whom you do business are willing to do business with you as a corporation. What commonly happens when you start a small business is that you try to sign contracts, whether it's leases, whether it's rentals of equipment, all those contracts that are routine in the operation of a business. You find that suddenly they're saying, "Oh, we want you to sign personally on this because you're a new business." And as a practical matter, sometimes you may have no bargaining leverage, and you have to do that, particularly with large landlords. However, I'll tell you that very soon, particularly in a favorable economic climate, you can insist that no, the only way we're going to do business with you is if I'm allowed to sign as an officer. That means when your name goes on the line, you have below it